Good morning. It's 10 a.m., just a little bit after November 12th, and thank you for joining the Capital Management Corporation webinar, Positioned for the Future. I'm Brad Shively, and I'm joined by the rest of the CMC investment team, Tim Call, Mark Livesay, and Joey Opkin. We have some prepared opening remarks, then to be followed by a brief presentation and followed up by Q&A. With Q&A, you can go into the questions box on your screen there and type in the question, or you can email me, bshively@the-cmc.com, and we'll be sure to answer. We've already received a fair number of questions going forward here. With that, I'll jump right into our prepared remarks. Already in 2020, we have seen the fastest recession and recovery on record, and a contested national presidential election. As we approach year-end, uncertainty in the markets remain, Senate runoffs, virus resurgence concerns, and additional stimulus. The stock market achieved a strong initial recovery as mega caps became more and more expensive. We believe we have reached a possible multi-year inflection point and see changing in the market leadership over the next several years. Our strategies are well positioned to benefit from this change. With that, I will pass it over to Mark Livesay.
Thank you, Brad. I've got a few slides here on the recent events that are impacting everyone's life and the stock market. The first one that's top of mind is the COVID-19 pandemic, which is ongoing. We've shown this slide before, but you can see from the light blue line that cases are at or near an all-time peak here in the United States, which is not good news. Deaths, however, which will lag, have not gotten as high as they were in April, and they have not yet eclipsed the July peak either. So that is great news. So the medical community has a better understanding of how to treat this disease, and there's more testing. So more and more people that may have light cases of the disease are testing positive and may not even have symptoms at all. We've gotten very encouraging news as recently as Monday on vaccines. Pfizer had an announcement that their vaccine was up to or over 90% effective in preventing COVID-19. That's tremendous. I saw that the flu shot is roughly 40 to 60% effective. So if you're at 90 plus for a vaccine, that's obviously very, very good news. To note, there are 3 other phase 3 studies ongoing in the United States. Moderna noted yesterday afternoon, that they feel like they could get some data out soon. So we might see news on Moderna's vaccine soon. J&J has a study, one of their sub-companies has a study out, and AstraZeneca has a study. So as we get vaccine news, obviously we can't predict whether it's going to be positive or negative, but that could determine trading for a given day or a given time period. We certainly saw that on Monday as the reopening stocks and cyclical stocks have done a lot better. But I think the very, very good news on this, and over the next few months, it could be rough sledding with more and more cases and the vaccine not being distributed fully until mid-2021 or early 2021. It will not be a straight line as far as fighting this disease, but we do feel like as we get into the second half of 2021, we have a much better outlook for the economy as it relates to COVID-19 because we have more and more arrows in the quiver to fight the disease, and the medical community knows much more about it today than they did even in February and March, which feels like forever ago, but in reality was not that long ago. The other, excuse me, my mouse is very sensitive. The other obvious newsworthy item over the last week or so has been the presidential, Senate, and presidential and congressional election. It is not fully resolved at this point, as the votes are continuing to be counted, and we have a runoff in Georgia, but we think the most likely scenario is a split Congress. You can see on this page 3 that under a Democratic president and a House and Senate that are not of the same party, which we believe is the most likely outcome, the average S&P change is 13.6%. This is since World War II, and that happens to be the largest percentage on the page. So it's not a bad outcome when you have a split Congress with a president of the Democratic Party. I will note that it's only been 4 years that's happened, so this isn't going to be dominating our investment thoughts, but it is good to know that we've had this situation in the past and it's been positive for the markets. We expect that the Senate will end up with between 50 and 52 Republicans. Currently, they have 50. There's a 2-seat runoff in Georgia. The Democrats will control the House of Representatives, although their majority shrank from 2018. That was a bit of a surprise. And given the split Congress, we're going to have limited legislative changes. So we believe that things that both parties can agree on will be the most likely to get done. Those being a COVID relief bill, and the parties might not agree currently on the size and scope, but they could come to an agreement on that. Helping drug pricing, keeping the cost of drugs lower. An infrastructure spending bill has been traditionally something that both parties can get behind. And in recent years, we've heard a lot more about technology antitrust. So we think those sorts of issues could be on the forefront with a split Congress. But overall, it's good to have the uncertainty of the election in the rear, or most of the uncertainty of the election in the rearview mirror. Obviously, there were a lot of different outcomes 2 weeks ago that were unknown, and now we know a lot of those. So the market can do quite well and has done quite well since the election. And I'm going to pass it to Joey to speak a little bit about monetary policy, which might not change nearly as much as these other things.
Thanks, Mark. All right, so just changing the slide. There we go. All right, so as Mark mentioned, really regardless of the election results, it seems like the recent quantitative easing monetary policy will be maintained into the future as the Federal Reserve has continued to be aggressive and is repurchasing treasuries very, very quickly in huge amounts, keeping interest rates at record lows. And as you've probably seen, it's really close to zero. So the stock market and the economy should benefit from this policy. Now the chart on the slide shows the monetary policy, the Federal Reserve assets, and the size of the U.S. economy as measured by GDP at near multi-year cyclical peaks in 2006 and 2019. The Federal Reserve used a similar quantitative easing policy, like going on right now, during the 2007-2009 financial crisis, which, as we've seen, has helped improve the U.S. economy and GDP. So using recent data and recent huge movements by the Federal Reserve and the government, CMC has estimated the money supply and the Federal Reserve assets at the end of 2021 to indicate that the monetary policy should increase the U.S.'s GDP and support the current economy. So then once a vaccine is put in place, whether it be from Moderna, Pfizer, or any of the other vaccines that are coming on the marketplace, and people begin to feel safe, the economy will begin to rebound with more business, and stocks could soar above pre-pandemic levels as things get back to normal. While the economy could continue or should continue to recover from its lows, there is a risk of inflation. When money supply rises faster than production, inflation is almost inevitable. Nonetheless, the continued monetary policy will make it very likely for the economy to rebound. So how is the market looking, Tim?
Thank you, Joey. The stock markets continue to rebound from their dramatic decline last spring. After a historic 10.5-year run, the largest capitalization stocks, mostly technology stocks, reached record-sized positions, a few having equity market capitalizations of $1 to $2 trillion each. The stock market capitalization of the largest technology company exceeded the market capitalization of all publicly traded companies in England combined, and became more than 2 times the size of all 600 companies in the S&P 600 small cap index. All of this is unprecedented. Accelerating growth of laptop sales, tablet sales, internet orders, and the number of Zoom meetings helped large cap technology valuations surge. Historically, the financial markets price for what is expected in 6 months. In 6 months, it will be May 2021. At that time, we fully expect laptop sales and tablet sales to be declining. Internet orders and Zoom meetings should continue to grow, albeit at a slower rate. Instead of accelerating growth, some large technology companies will have decelerating revenue and earnings growth. This should lead to their having lower valuation multiples. With 5 companies representing almost a quarter of the S&P 500 and 14 companies representing well over half of the NASDAQ, those indices appear top-heavy. In the meantime, the majority of stocks now appear in value indices. Several of these companies have impressive track records, resilient managements, superior products, and strong outlooks. Because they have low valuations, they are placed in value indices. We find these specific stocks of growing companies to offer tremendous opportunity. As Joey stated, America will reopen with increasing levels of confidence. In 6 months, there might be more than one FDA-approved vaccine, fewer state-mandated restrictions, and more in-person consumer activity. With greater confidence in health, safety, and employment, uncertainty declines, and some personal and corporate emergency savings levels will be utilized, spent, or invested. This activity will further bolster the economic rebound. News of continued economic growth will further increase consumer, corporate, and investor confidence, leading to even more reinvestment and spending. Historically, such a positive spiral eventually creates pockets of inflation, which the Federal Reserve attempts to squash with tighter money, slower balance sheet growth, and rising interest rates. Currently, we are near the beginning of this economic cycle. Some stores are finally reopening. Overnight interest rates are at 0. Money is being printed, and another federal stimulus package is in the works. Unlike last spring, if a governor restricts some industries, no one will be surprised. Possibly emotional, but not surprised. One of my favorite indicators is traffic. When driving, it is calming to remember that increasing road traffic indicates economic growth. Traffic has certainly increased over the last 3 months. Regretfully, it can increase a lot more. Washington has changed too. Surprisingly, both Democrat and Republican politicians want to restrict, regulate, and possibly break up massive technology companies. Some of these firms maintained a competitive advantage through buying or pummeling small competitors. As this will no longer be allowed, competition will increase. Increased competition leads to greater innovation and lower prices, both of which benefit the consumer. However, competition can harm incumbent market-dominating companies. As economic activity recovers, there will be some shortages and resulting price increases. This year, lumber prices have almost doubled, labor costs are already increasing, and package delivery pricing has started to surge. temporary holiday price increases for package delivery will be replaced with a large permanent price increase in January. Happy New Year. While capacity in package delivery remains tight, prices should continue to rise. Since the average company cannot control its costs and has a hard time raising prices, one should not invest in average companies. Investors should select companies that can raise prices and control costs. Meanwhile, baby boomers are retiring in record numbers. How will retirees, endowments, and foundations live off their savings and preserve principal when overnight interest rates remain zero? Currently, our growth stock accounts have dividend yields greater than bond yields. Our dividend-oriented strategies have dividend yields above 4%. Those recurring cash dividends can be spent while the principal remains untouched, thus allowing all of the principal to work for the investor and provide long-term compounding with the goal to far exceed inflation. This next chart shows what we consider to be the end of an extended large cap growth cycle ending on August 31st. A standard US large cap index and a growth index had generated returns of 52% and 94% over the trailing 3-year period ending August 31st, while their small cap and value counterparts only generated returns of 19 and 16%. These differentials are historic in proportion. However, since August 31st, those trends have reversed. A full reversion to the mean should take several years and be quite rewarding. After prior 10-year growth and large cap cycles, value and small cap stocks tended to have an even better decade relative to their counterparts. Why did this inflection point in market leadership occur on August 31st? Since the market likes to look forward 6 months, in theory, after August 31st of this year, the market was starting to price in the fundamentals of March of next year and beyond. Last March is when the economy and confidence fell apart and uncertainty surged. Starting next March, many companies will start to generate strong year-over-year sales growth against rather easy comparisons. These are the reasons market leadership is changing. Many investors purchase mega cap tech stocks or index funds dominated by large cap tech stocks because they look really good in the rearview mirror. Yet many of those companies are overvalued and have slowing fundamentals, or will have slowing fundamentals next year. As entry price is a key determinant of investment return, we think many large cap tech stocks and index funds should be avoided at this time. Long-term investors should focus on growing companies with attractive entry prices. In other words, undervalued, overlooked companies with prospects of growing revenue, profits, and excess cash generation are attractive. Some of our holdings hoard the excess cash they generate until they find the right acquisition candidate. Other growing cash cows regularly reinvest in their own businesses, pay down debt, repurchase stock, or pay and raise their cash dividends. When we find an attractively priced growth company generating so much cash that it can do all of these at the same time, we make it a large position. While some large cap stocks outside the technology sector are undervalued, we also find ignored, underappreciated small and mid capitalization stocks, under 10 billion in market capitalization. That's billion with a B. In the US, most $10 billion firms are considered mid-size, not large. Meanwhile, $2 billion firms are designated as small. Remember when Thurston Howell was a millionaire and that meant something? Now 2 billion is small and 10 billion is not considered large. Today, most recognized Wall Street brokerage firms and analysts do not pay attention to $10 billion firms. In turn, their entry prices have become more attractive. In order to beat the NASDAQ over the last 3 years, it helped to only hold a handful of very large technology stocks. That is not the sign of a healthy market or a diversified portfolio. We believe this has finally changed. We are diversified by sector, industry, and market geography and size. We are finding attractive companies that are large caps, mid caps, and small caps. We can find attractive companies in almost every economic sector, including some technology stocks that benefit from the 5G telecom rollout. We own deep cyclical stocks in the financial sector that trade at steep discounts to their historical norms. Our investments include media companies benefiting from OTT, 5G, streaming, and new content. We have lithium firms with leading chemistry to advance rechargeable battery technology. Medical firms creating new treatments and cures. And even natural gas conduits and storage companies with increasing scarcity value as the economy grows and fewer permits are issued for potential competing pipelines. Since we look for growing companies generating excess cash, many of our holdings pay attractive quarterly dividends and tend to increase them annually. Whether it is baby boomers retiring in record numbers in a low interest rate environment, nonprofits needing to generate income while growing principal, new technologies like 5G, OTT, recharging, streaming, biotech, and regeneration, or deep cyclicals and financials and energy conduits, your portfolios are not just positioned for long-term growth and an economic cycle. Your portfolios are positioned for this economic cycle. Before passing back to Brad, and before losing my voice, I want to say that we recognize these are stressful times for our nation, the economy, and business. We hope that you and your families are safe and well. Our top priority continues to be the safety, health, and financial well-being of our clients and coworkers. Our firm operates as one team. I wanted to share on a personal note that I've never been prouder of our team. Throughout this pandemic, despite personal and professional challenges, our team members have worked tirelessly and remained focused on our fiduciary duty, on your long-term investment results, and on client service. Trades were made to limit taxes, to adapt to this historic pandemic, and to position for eventual economic recovery. We believe our client portfolios are currently well positioned for the future. Brad, please moderate the question and answer session.
Absolutely, Tim. At this point, if you have any questions, feel free to type them into the question box there, and also we will address them here. We'll just take a couple seconds here to pull together all the questions. Bear with us one second. All right, I'll just start it off here. First off, there was a question that came in here, and I'll put this to Tim. There was a mention before about concerns going forward with rising inflation. The Federal Reserve has indicated they intend to hold interest rates down until inflation is above 2%. Does this mean we need to be concerned about the inflation now or near term? Tim?
Inflation hasn't shown up in aggregate yet there's going to be excess capacity in some areas of the economy for at least another year, such as in travel. And there are other areas that have recurring deflation, according to the government, such as technology. Since your phone is 30,000 times more powerful than your first personal computer, the government says that represents a lot of deflation, despite your new phone costing a lot of money. And so that's put into the aggregate. So as we see pockets of inflation and increasing inflation in different aspects, it's averaged out at first. And so there won't be an immediate fear of inflation. But as we start reporting numbers above 2%, the Federal Reserve will be less inclined to print so much money to stimulate the economy. And as they cut back on printing money, that leaves them less to buy government bonds and mortgage-backed securities. So long-term interest rates will start to rise first before the Federal Reserve raises overnight interest rates. And that will hurt different investments, such as bonds, long-term bonds, and highly leveraged companies. Also, inflation in general is a cost for companies that is sometimes not recouped. So investors need to pay attention to these different pockets of inflation and how they affect particular investments. So companies that depend heavily on deliveries and investors who are in bonds need to be cautious. Particularly, we would avoid long-term fixed bonds, as no one wants a low interest rate bond after interest rates rise. So you can actually lose double-digit market valuation in bonds. And so we might see that in the next 2 years.
All right, thanks, Tim. Next question, Mark. With the presumptuous transition of the White House to more of a Biden administration and the prospects of a vaccine near term, does CMC see a rotation into more cyclical plays and such COVID vaccine distribution channels, such as a FedEx, et cetera, on the logistics side?
Yeah, so I think we do see with the vaccine success or potential vaccine success, a rotation into more cyclical plays. I think that's a lot of what Tim was talking about with his prepared comments. We see a rotation into cyclicals, and certainly when you have the economy ramping up, that's good for cyclicals as well. So there's kind of a double positive, so to speak. On the distribution side, we have bought in some accounts Walgreens, so that stock is very inexpensive. And as the economy opens up, not only here but in England, more people, their foot traffic will go up, and their more profitable front of store should benefit. On the distribution side, we've owned UPS and Pitney Bowes, and while we don't think that the medical distribution is going to be a huge generator of profits for those companies over the medium to long term, it could get a short-term bounce post-holidays from increased vaccinations being put through the system. I think the bigger impact, though, for those companies is going to be this accelerated shift to online shopping. So online shopping had been a growing part of the economy for years, and we basically moved from 2020 to 2025 in 1 year. So we've had 5 years worth of growth in one due to the pandemic, and I think that's going to have a much bigger impact longer term. So we still do like some names in the logistics area, UPS and Pitney specifically.
All right, great. Tim, next question is, will the transition away from fossil fuels impact the small and mid-cap dividend-paying stocks?
Well, it will if those are oil and gas developers. Many of those are in a cash crunch because of low product prices over the last year, and they are less profitable and likely cutting dividends. And we'll see that with small companies and with large companies as well. So we would avoid producers of those commodities. And we do think those dividends in the energy sector are at risk. We do like the pipeline companies that act as basically tolling booths or leasers of capacity. So the natural gas will move through a pipeline to get to a major city. So the municipality can sell natural gas to us and to get to utilities so they can produce clean energy and we can plug our electric cars in and get those recharged. So sometimes the wind won't blow and it'll be too cloudy or it'll be nighttime and we won't be able to create as much renewable energy. And so we need peak energy production from natural gas turbines. And so those pipelines bringing natural gas to the cities are vital. But we expect permitting for new pipelines or expanded pipelines to be cut back even more so than before. And as those existing pipelines face less future competition, and as the economy grows, there's a scarcity value that the existing pipelines are in greater and greater demand, and they can charge more. So those pipeline companies, they don't own the commodity, but they can raise their tolls when they're the one of the few pipelines in an area, and competitors aren't allowed to build any more capacity. So we do think dividends are strong and continuing and of high quality with those pipeline companies. And so that's just one segment of energy that we like, where most segments, such as production, we do not find attractive at this time.
Great. Mark, next one's for you. What do you expect with regard to capital gain taxes?
Right now, I don't expect any changes. That would be a legislative change that I don't think the Senate Republicans and House Democrats and White House would come to an agreement on. I think that was one of the potential reasons for the market doing very well since the election, is that the split government will likely result in no changes to capital gains tax rates. Now, there's no guarantee to that, but that is the current expectation right now.
Another question here, Tim. Do you see the U.S. dollar starting to lose relative strength? And if so, will that mean international stocks, both developed and emerging, will start to outperform?
As investors look forward to reopened economies and have more certainty, we do think international markets, especially developed markets, can see a rebound. So many of the stock prices in international developed markets are cheap right now, and a falling dollar makes them even makes them more competitive when selling exports to us. And I'm sorry, a falling dollar makes their returns. I'm sorry, the stock returns are higher for international stocks when the dollar's falling. So even if the international stock stays at the same valuation in their currency, because of a falling dollar, it's worth more in our currency. And a falling dollar does increase import prices for the United States, which hurts U.S. importers. It also lowers our export prices, making our exporters more competitive. So it will affect our companies differently. But in general, where economies remain open, the international markets should eventually start to rebound from low valuations, and it is something to watch. We do think there's still more risk of economic closures and cutbacks, and because of that, we would avoid short-term the emerging markets, especially in Latin America, as they would have a high beta to such events. But they, again, in a year might be attractive as well.
Great. And with that, that is where we are at with the end of our Q&A session here. We appreciate everyone's time. And, actually, one more question here, and I'll let go here. Mark, are there any dividend-paying battery manufacturing companies that would be a good investment?
We do have one that the dividend is not very high, but EnerSys is a battery company that we feel good about. They're more of a traditional player, but they pay a dividend. It's not high. I'm looking right now. The yield right now is 0.86%, but that's one we feel good about. A lot of the kind of new battery technology companies do not pay dividends and do not generate positive cash flow. The way we have decided to play those companies is with Livent, which is a lithium producer, and that's the material that they need to make their battery. And Livent does have positive earnings most years and cash flows. That stock does not pay a dividend, however. Was a spin out, does not pay a dividend, but we think it's a better way to play it with that material play. And the stock had been very, very cheap, and over the last month or so has become less so, but we think that's the easier way to play because a lot of those battery technology companies are very young and not cash flow positive. And so we do not feel great about companies that are not cash flow positive. But EnerSys and Livent would be two ways to play those that we feel very good about.
Great, thank you. And with that, we will conclude our presentation today. And if there are any follow-up questions, please feel free. You can reach out to Tim, Mark, Joey, or myself. And we really appreciate everyone's time and patience today. And we look forward to a strong end of the year as well as a strong 2021. And look forward to speaking with each of you as we go forward. Thank you for your time today.